Welcome everybody. Another month, another pension committee, pension advisory committee meeting. So it's August. The year's gone fast. I can't believe it's summer's almost over. All right, let's. Did I don't remember if I remember seeing minutes going out. Did I miss that?
They were on the website, so they've been around for a while.
Okay, but no email.
I don't know if Jackie didn't attach them. She may have forgotten. She typed them up because they have to be typed up and put up quickly. She probably forgot that, they were done very quickly after the meeting.
Okay. So, well, unfortunately, I didn't think to look at the website. I didn't realize that. Anyway, it just occurred to me that I didn't get them, so I didn't get the email. So, did anybody else have a chance to look at the minutes?
I did.
Anybody else? Anybody else?
Comments.
Well, I looked at them, but I wasn't at the meeting last month.
Okay.
I can make a motion to approve them.
Well, if only one person looked at it, it sounds like only two people looked at them.
I have to go back and I don't know if I looked at them, to be honest with you. I'd have to go back and see if I can find them. So we should probably defer.
Yeah, let's just delay until next month.
Yeah.
The review of those minutes. All right. So, okay, then old business is surely we have some old business, but given Deb's joining us today, we'll jump right to new business. And so, Deb, welcome. Thanks for joining us. How are you doing?
I'm doing good. I'm actually on vacation, but I haven't had vacation yet because it's been such a busy day today. But it's good to see you guys. And
so, did you go anywhere?
No. We haven't had the spike in Boston area right now, but a lot of the areas around us are spiking, so it's stay-at-home vacation, which is good. Could get a lot of reading done.
What do you got planned?
No plans. Maybe clean out a couple of closets, but it's 90 degrees out. We don't have air conditioning, so it's pretty hot to even be trying to clean out something. So I think I'll just read some books. So it's good.
Okay, there you go. All right. Well, thanks for joining us. So anyway, so you want to take it over?
Yes. I know you were sent out the pension report earlier. I don't want to read it to you. Is there any specific places you want me to go over there? Or do you want me to talk about where things are today? What would you like me to do?
Yeah, if you could kind of cover on a top level, obviously, we're all, we're all generally familiar with stuff going on. So if you maybe sort of approach it from things we should be concerned about and your thoughts on the market and the performance would be helpful. Sounds
great. Well, as you saw from the end of June, you guys were down about 5.5% is what you saw at that point in time. And remember, we were coming off of the market hit its lows on March 23rd, where it's down about 34% at that point. We were starting that V-shaped recovery we've been going through. And as of last night's close, we were actually seeing the S&P up 3.73%. There's a real dichotomy happening in the market. So we're seeing the growth side of the market, which is really the technology side, way ahead of performance of what's happening on the value side. Of course, on the value side, you are going to have things like the bank stocks, the oil stocks would be in there, energy stocks, utilities. Healthcare would be in there, but healthcare, parts of it have moved ahead here. But we were still seeing a down point at this time when this report came out. And what you were down 5.5. What you're if we look at the benchmark indices, the target weightings that we use, it would be down 4.93, and that's without any fees at all because indices have nothing in them. So you fared very well on that. Year to date, as of last night's close, we're actually pretty flat. We're down about maybe $35,000 on the accounts, which is very flat. But let me just give you something, because I think this is I found it interesting when I was looking over this earlier today. When I look at things like your, the S&P 500 is up 3.73. You guys on your large blend are actually up 4.31, and it's because of you staging that money in. Now remember, we're buying indices or indexes with this, so it's very hard you can't really outperform an index if you're buying the index. But what is helping you is that money coming in. When we look at the value side of the market, the large value of the S&P is as if you just had an index and you just bought it on January January 1st and you now had it today, you'd be down 10.2%. You guys are actually down 8.32, so you're beating it by almost 2 percentage points. On the large growth side, you're up 1881, the index is up 18.3. But on some of these areas, it's a huge spread because of that money being staged in. Plus, we took advantage of those areas of the markets that were down, like mid cap and small cap have been down a lot more than the large. So we were taking advantage of that. The small mid cap value right now, you guys are down 7.21, but the index, even though you own the index, if you just didn't put anything in or out of it, you'd be down 14.89, almost double what you're actually down. The mid cap growth is up 4.03. You guys are up 10.54. The small cap is huge. You're down 9.86 on the small cap value, but the index is down 22.45. You're actually positive on the small growth, positive 4.17, and the index is down negative 6.89. So it's really helped you to have this money coming in like you are averaging in. So I just want to say it's made a big difference with what we see on your performance here. The other thing I did is when right at the end of June, I look at every holding I have out there with all my clients, and of course including yours, and I made some changes in certain parts of the bond market, and it had to do with my concerns about defaults with corporate bonds. What you've been hearing out there, I'm sure, is the fact that even Brooks Brothers just went into bankruptcy. It's a place I've been buying my suits since I started out in this business. And Ralph Lauren actually launched his actual, not Ralph Lauren company, but he launched his own business when he was selling neckties to them back in the day. Neiman Marcus went under, they've declared bankruptcy. Lord & Taylor, which has been out there for well over 100 years, declared bankruptcy. So we're getting some pretty scary things happening in this market. I mean, today Amazon went down in price about 0.5%, a little over 0.5%, because they're talking about taking over space of where JCPenney and Sears are in malls. They're going to use that as fulfillment centers. Remember, you do have the Amazons, you have the Facebooks, the Googles. What's moved the market here, and you saw from the numbers I just read off, has been the technology side, which is growth, and that's what you're seeing moving here. I mean, you're on a Zoom call. I personally never did a Zoom call prior to COVID. I'd heard about them, I read about the company, but didn't do a call. Now it's like, it seems like I'm on Zoom calls all the time, or more than I care to be on, but because there's so many of them. But it's the idea that you're positioned well, your allocation's good. I did make some changes on the bond side, and I'll talk about what I did. And I'll have more of this in your report for the next quarter. But when I was looking, high yield corporate bonds are going to be your most risky part of the bond market because they're the ones that are below BBB rated. So when you look at the bond market, AAA is your highest rating, then AA, then A, then BBB. Anything below BBB hits into the high yield market. They're still an important component to have because so many of our US bonds are high yield bonds. So many companies are that way. I actually moved you out of AB High Income Fund. I did it with my clients and moved into Vanguard High Yield Corporate. The main reason I did that is because Vanguard has the most conservative strategy right now in high yields. When you look at their strategy, they're keeping about 5% in liquid assets in treasuries because of just redemptions going through. So I made that change. We're actually up 3.61% since I did that. It yields about 5.12. So I still want to keep a portion in high yield. The other part that you have that is high yield related is your floating rate bonds. But the difference there is these are collateralized by banks. So if there was ever a default, it would be in line right underneath. It's ahead of any bonds. It's ahead of the equity market, of course, and even preferreds. But it's right in line after these companies would pay their rent, their employees, that type of thing. I moved you from the Fidelity Advisor floating rate, which has always been considered a conservative fund. But what they've been doing is they've been going more and more in the last 12 months into taking some more risk on the market. So I moved you over to T. Rowe Price floating rate because they They just do a better job on the risk management. Once again, I'm concerned about anything to do that's in triple B or anything below triple B rated. And they also maintain 10 to 20% in liquid assets. So they're just trying to keep some liquidity there. We saw some problems in March with liquidity in the bond market, especially on the muni market. We were seeing bids on municipal bonds, a huge spread. We were seeing bids on even the high grade corporate bonds as large spreads. It is because there was a liquidity crunch because you had companies that just needed to raise cash and they needed to, some of them were pulling money out of their bonds because they wanted to come out of, they didn't want to take the hit of the stock market. So once again, I did a whole thing with all my bond holdings and made some changes. The other thing I saw happening is on your Templeton Global Bond, they were always a global bond fund. They're now considered a U.S. non-traditional bond. I don't need something else in that category for you because I already have that. So I moved that over to the PIMCO International Bond, the hedged one that you already own. Great management team. They hedged against the dollar. It's just done phenomenal. So I've moved more toward that. Lastly, on emerging market debt, Goldman has always been one of the gold standards in emerging market, but their management seems to have a weak spot on the currency side of it, and we saw it happen in this March downturn. I didn't like what I saw. The other thing that's happening is they're talking about one of the top managers possibly retiring here. So I moved it over to MFS Emerging Market Debt. They're doing a great job. I've had MFS, I've had them both out there, but I favored Goldman over it. So I made that move just to kind of err on the side of caution. It's actually up 3.3 since we bought it. It's yielding about 4.33. All the bond funds moved up since we bought them on that side of it. So that's the only thing I did except do some rebalancing on the account. I still think we could see another downturn. I'm not expecting it to be the 34% drop we had. When I listen to CNBC and Bloomberg in the background as I'm working remotely, about half of them seem to be saying maybe a 10% downturn. Others say it's just going to be in a trading range. I just don't like what I'm hearing about the economy and the numbers out there. If any of you listen to the quarterly earnings reports, they were atrocious. Analysts are giving them a pass because they know they were atrocious. So right now, analysts they haven't seemed to care about the first quarter or this second quarter earnings. The market's trading on us getting a good vaccine, the country getting a vaccination that works, or at least good therapeutics. Keep in mind, there's no vaccination for HIV, but we've got good therapeutics. So therefore, if people get it, they still can live to a ripe old age as long as they're taking the drugs. So I'm cautious. I think we're going to be in a trading range here. I believe your allocation is good of 65-35. I'm still 100% equity myself. I haven't put anything out of the equity market, so I'm still believing that long term it's going to come back strong. We had a good economy in January, February, and even last year. I don't think it's going to come back immediately because there's going to be some job losses. They're going to be permanent losses. I think you're going to see some changes with real estate, big time, commercial real estate especially. I think you're going to see, we're already hearing it out there where companies are looking and saying, well, we don't need to have a location in downtown Manhattan. People can work remotely. Maybe we'll keep instead of, Nationwide came out and said instead of 10 buildings, they might keep 6 of the buildings. So some things will be happening on the commercial real estate side. I think technology will still be a leader. I think the growth side is still a strong place to be in, even though it's moved so much here. I don't want to pare back what you have because I've got enough in the value side, but the value side is really beat up. And that's, you look at things like, I put together some stocks today for a client, and you look at even things such as in the industrial side, ADP down 24% from its highs, Lockheed Martin down 12, just across the board they're beat up. Waste Management down 12, Honeywell down 14. Great companies are beat up right now, so I think there's opportunity still. Any questions? I know I said a lot, and I didn't mean to be shutting up.
Well,
So
I was wondering, so if you elaborate, I mean, certainly there seems to be a disconnect between the economy and the stock market.
Yeah.
Elaborate a little bit more on your thoughts on that.
And why that is because the stock market trades on future. It trades in the future. It generally goes out 6 months. Sometimes when we were seeing the first quarters, it was really trading out a year from now is what it was doing. It's trading out into what is going to happen into 2021. It's going past the elections. It's going into saying we're going to have a virus, a vaccination or therapeutic, and that's why they're believing things will turn around. A lot of thought out there is that we have a pent-up demand. I can tell you, it almost seems like every client I talk to, they want to be out at a restaurant, they want to go on a trip, they want to go see their kids, they want to do something, they want to go out and to a movie. They can't do any of this stuff, or they don't feel they can do any of this stuff. So they talk about that pent-up demand. We've seen it. If you go back to 2008, you remember even General Motors went bankrupt. And people weren't buying cars in 2008, and then the pent-up demand by 2010, these companies had record earnings. We saw the same thing in 2000 after the world trade blew and people weren't getting on airplanes. So you saw airlines did horrible, hotels did horrible. Well, hotels still held up okay, but we still saw a type of entertainment, places where like the Disneys went down. But then there was a pent-up demand. Within 2 years later, airlines were having record profits at that point. But I still think the technology will be the leader going out here because I think people are just embracing it. People that maybe had not used certain things. I mean, I personally figured out how to use Apple TV myself because I'm down to every so often you want to watch something on television, and it seems to be a good way to get it. But anyways, so there's a disconnect because the market doesn't trade based on the economy today, and that's the main disconnect, Ed, that's happening right now.
All right, so it sounds basically everything you're saying is that you're not advising or advocating that the township do anything other than hold its current allocations. Is that what I'm hearing?
Because you're 65-35. I wouldn't go to 60-40. That would be a classic balanced portfolio because the yields are so bad. You go out on the 30-year treasury, you get 1.30%. There's just no yield in it. We've got a mixture of different kinds of bonds, and our yield on our bonds.
Deborah, I hear you about 60-40, but I'm just wondering, given what you've just said, within the 65-35, should there be a distribution within that?
There is. You got a major one.
A change in the distribution within
no.
the 65-35.
Well, we've reallocated back to what I see the big pension plans doing. Remember, I'm looking at what Wilshire's doing and Ibbotson's doing, and I use them as the guide. And they had very little change over 19 to 20, as a matter of fact. What we have done is when the markets dropped back, we were doing some reallocations from the bond to the equities. As money was coming in, we were buying more equities. That's why you've seen these great returns. But if we weren't buying that, we'd have been still selling off some bonds and buying into equities to do the rebalancing. You'd had that happening anyways. You are already getting that, Joe. In other words, you've got small cap, mid cap. What I've been kind of watching closely is the value side. The value side has now had a couple of years of underperforming, yet those are areas of the market that are really important areas. I mean, we are still on a fossil fuel country as the rest of the world. Everything's not energy efficient yet, but those oils are way down, and that's part of the value side. Banks are way down because banks, they've been hit about the fact that what if there's default? So the banks had to shore up money. Well, once again, to answer your question, we're doing what you're talking about. You're getting a rebalance there. You're getting money going into those areas that are down when it's coming in. And that's why you're seeing an outperformance of your actual owning of that index over you just having the index from January 1st and not having any change to it. In other words, money's flowing in and out of those indexes. Is that making sense, Joe?
Yep. Thank
Okay.
you.
Tom, any thoughts?
Yeah, I have a couple of thoughts. I did look over the report in detail. I have a couple of observations. And if you could clarify, the first half, we were down 5.5%,
Right,
correct? The benchmark you were using was down 4.9?
4.93, right?
Okay, so slight underperformance there.
But it's because you have to have, there's going to be a charge somewhere to have this stuff managed. So that's, if you took out the half, if you took out a half, or if you added a 0.5% to this, you can't just buy the, you know, you add a 0.5% to it, you're pretty much right on top of it, or really close to it.
Okay. Second quarter was certainly much better than the first quarter.
Yes.
We struggled dearly for all sorts of reasons. And the first half, so I would say to you, we have been talking on the PAC about adopting a reference benchmark,
Right.
which is basically a simple 65-35 allocation to two securities, the MSCI ACWI, representing global equities, and the Barclays Aggregate, representing fixed income. This is plain vanilla, high level, low cost. So instead of us owning 23 investments, if we own 2 investments, this is the reference benchmark. Now we use this for discussion purpose in our meetings and just to get a feel for what's going on. Because it's easy to do, it's easy to calculate using those 2 particular ETFs. The benchmark you are using, is that constructed from our actual investments?
It's constructed from your actual, not from actually what you currently have. What's constructed from you actually have is on page 23. So 22 is taken from those target weightings. That's our target weighting. So in other words, I'm targetly weighting the blend to be at 10%. I don't always write it at 10. I can sometimes write it at 12 or 11, but it comes, sometimes I'll write it at 8. So that's my target area. Just like your target's 65-35, there are times you're sitting at 66, or times you're in equities, sometimes you're sitting at 64, because it's just going to have its times within there. But there's a target set for the large blend, large growth. So I've got about 30% of your money in the large part of the equity market. Then I've got about 8% in the mid cap, and then you can see you've got 5.25% in the small cap. So those are target weightings, and they're taken off of. I'm looking at what Ibbotson's doing, Wilshire's doing. It's coming across from all of that. Is where those targets are coming from.
So those targeted weightings are determined by you at your discretion?
They're determined by me at my discretion, but that's the target I'm going for, because you can't just change those every month. There's just so much trading to do on that. But we're constantly updating those guys. I'm looking at the account pretty much twice a month on it to see how much off it is. But the next one, the next page after that, which is page 23, gives you the breakout by what you actually have in those classes. You know, in what is actually in the U.S. Versus the foreign, and it breaks out each of those categories. But it's by what you actually own, and it's comparing it to the index is what it's doing.
But we see no aggregate number. No aggregate for equity, no aggregate for fixed income.
Well, there an aggregate for the whole thing. We didn't aggregate out the, what you do get the page before is a breakout by what the bonds are doing versus the equities are doing. But I can give you that quotation. You guys are going to get back to me on that. I had not heard back from you if you wanted me to run that. I know we talked about that when I was down there with one of my team members, Nate. So do you want me to get rid of this page, or do you want this page plus that?
Well, page 22 is an interesting page because it has the sub-allocations, if you will, which you've determined, which are fine. But there's no data associated with that. So it would be nice to see the benchmark for each of those sub-allocations and then our actual performance.
Well, that's behind that. But I'm sorry, but if you look at page 20, it gives you your actual benchmark that's behind that. You see the year-to-date numbers. This is basically taken from, these are taken from, the benchmark is right there. So you can see the S&P 500 growth, that quarter's up, that year to date was up 7.93. If you look at page 20, that gives you what the benchmarks were doing. I just think it's too much data for one page because there's pages and pages of data here. You get to a point where it becomes, that's why we just show you the percentage into it. But you could see that, tell me what you'd want. You want me to put next to that what that quarter did in that particular, the blend, which is to be the S&P 500, what it did in the growth side? Is that what you're looking for here?
Yeah, well, I'd like to see the benchmark performance and our investment performance side by
Side by side, I guess.
side. By side.
Doing that on page 20 is what I'm trying to say to you. I'm already doing that on page 20.
But it's in a format that's unwieldy.
It's,
We have a bunch of investments and a bunch of benchmarks. And I spend a lot of time looking through what's outperforming a benchmark. I'll layer in again this reference benchmark we've been talking about, which is another background issue. And if life was extremely simple, frankly, our performance would be much better, particularly on a trailing 1 year basis. 65-35, MSCI ACWI Barclays Aggregate is up 4.4%. We're up 0.25% on a trailing 1 year. And so I went to the trouble of disaggregating all of your sub allocations and comparing them to the MSCI ACWI. And very simply, we are overweight US, which has been good, but we're underweight large cap because we're overweight mid cap and small cap, which
well, you're not overweighted mid cap and small cap. If I'm looking at what pension plans are doing, like the largest ones of Wilshire, they're not buying the MSCI index. I'm doing it as the big boys are doing, so to speak. And I understand it's a smaller account relative to the CalPERS pension plan, the rest of them, but that's why the breakouts here. Because if you look at over time, forget a 1 year basis, look at over time, small cap and mid cap have been better performers than the large cap if we go back through the Great Depression. They beat it by about 2 percentage points. That's why right now, small and mid cap we know are underperforming large cap and over the last year, that's for sure, but that's not true of over time. But I can get rid of anything you want. If you want me to get rid of having small cap, mid cap, I can do whatever, but now you're running the portfolio, I'm not. You guys take on the fiduciary responsibility of that, and just keep that all in mind. But I will do whatever you want. I just need some real clear direction. So if you want me to have page 22, do you want me to get rid of page 21 and 20 and 21 then? You need those pages because you had wanted pages going back 10 years.
Yes, no, it's good to see that data. There's no question.
Okay.
And so take our U.S. equity allocation. It's 10 core, 10% growth, 10% value, correct?
Because 30% is in large cap, right?
Yeah, but in terms of style, since we have equal weights in growth and value, we are not making a growth or value bet. We're making a neutral bet because the growth plus the value equals the core.
That's right. And so if I look at right now in the holdings that we have, we've got in there, we are sitting with 11.36% growth today and 10.15 on the value side and 12%, I'm sorry, 12.03 on growth, 10.15 on value. Because those are my target weightings, but I can go outside of those by a couple percentage points, which I have. On the blend side, you're seeing 11.36. So we are overweighted on slightly on the growth versus the value, but most pension managers aren't trying to make bets on a market. They're going to keep it. I put more toward large growth. I know that, but I'm just saying to you, I'm not going to sit there and put 5% in value and 15% in growth, because if we look at where the market is expensive right now, it's the technology stocks that are expensive. That's what's moved. If you look at the S&P 500, it's really been a basket of technology stocks, probably about 5 of them that have moved plus Amazon, and that's been the market. The rest are down. So I am not going to, I can't make those kind of bets. I can make those kind of bets. I don't think it's prudent with a pension plan. But if you,
But at the targeted weight allocation, making equal bets in each is neutralizing the style bet.
yeah,
So,
and what's wrong with that for a pension plan?
well, we should just have money in the core. We should just have money in the core, core blend US, in a core mid cap and in a core small cap.
Because that would be cheaper, I think you said, Tom,
And it
right?
would be cheaper. The fees are 20%. 20% of what the fees are on those style ETFs.
I don't agree with you. Those ETFs are extremely cheap on all of those. You're in the iShares of every one of them.
They're about 25 basis points, 24 basis points each. The major market indices, large, mid, and small, are single digit fees.
I'm sorry. You're telling me that the S&P 500. I don't have the reports in front of me, so I apologize for that. But if I look, you need the reports in the back here. Hold on a second. The reports in the back. So wait 1 second. So I just go back to what you're saying. Okay, so we're looking at your indices right here. So the S&P, the growth is, the fee on that is 0.10 expense ratio on the S&P 500 growth. That's your expense ratio. 0.2, so S&P 500 is 0.03 and 0.04. What is the minimum volatility? The value side is 0.19 on the expense ratio on that. Yes, you're right. The S&P is going to be cheaper because there's just more in it. You're right. There's probably because it's a larger portfolio, but we're not exactly totally neutralized as far as the account goes. I mean, if you pull the holdings right today, and I didn't pull them back from that date, but we are looking at, we've got more in the growth than on the value side right now. That's why I've been riding it. Same thing is true on the small cap versus small cap value. But the value and growth change very rapidly between value and growth. I mean, they change. Those asset classes will have, we saw a change happen even earlier this summer when value started to move ahead of growth. But I don't look back on a one-year basis only. So I think that's the main thing that I'm seeing with that I understand with what you're talking about. So help me out here. What do you want me to do?
Let me just sort of jump in here for a second. First of all, what our role is certainly just trying to look out for the township and sort of ask the dumb question, because we know the Board of Supervisors, et cetera, don't have time for it. And certainly, the township is relying on you to make the decision. So we're not advocating you to do anything. We're just asking relevant questions just to kind of kick the tires. So I don't want you to get the impression that we're trying to give you investment advice. We're just basically asking logical questions, we hope.
Well, MSCI has very.
If I could interject, a lot of these things were developed or agreed upon with Deborah back when she first started. And in all due respect, and in all honesty, I don't think there's been an update since then. So we're looking at data or agreements or understandings that are many, many years old. And I think what we're trying to do as a group is, one, understand, two, decide if there's any changes needed. And it's not a reflection on what's being done, but how do we go forward?
Well,
Okay.
Joe, one thing is we've made major changes. This is not the report that you had a year and a half ago. We put this report together based on.
I understand we went to index funds.
No, but we also changed this
we went to
reporting.
passive funds on the
Yep.
equity side,
Yep.
and we're still active on the on the bond side.
Bond side,
And,
right.
and in my opinion, one, again, it's my opinion, we ought to look at the cost versus benefits of being passive on the bond side because the rates of return are so low. Okay. We're talking about changes of basis points, et cetera, et cetera. You know, today the market was up this morning. I looked at it, and I look at the market every day. Okay. Today the market was up 250 points, and my portfolio was down. Okay. Again, only because of where my portfolio sits in relation to
The S&P.
the Dow.
Right.
So things change. It's dynamic, et cetera, et cetera. I think what we're trying to do is, one, get a basic understanding, and two, improve the process, and three, most importantly, pass that information on to the Board of Supervisors. They
Right.
need to know where we're at. They need to know where we're at in terms of performance, and the flip side, which you don't see, Deborah, is the fact that there is a underfunding in the pension plan,
Right, I know that.
which is directly attributable to the performance.
Right.
Well, actually, no, it's really more attributed to the discount rate.
But it also contributes to the amount of money that's gone into it over the years. There's a lot in the
That's right.
performance
That's right.
combination. It's also the fact that they've made some changes with Pennsylvania with different, some of your acts in there that have affected your actuals, that have affected the numbers toward the actual assumptions.
So I mean, I think, sorry, yeah, so Deb, just to summarize what everyone's been saying so far. So basically, we I think it's important to, you're certainly working on this to optimize the return for the township, and we're looking to sort of, be an observer to just ask questions, and then if we, and then, like the question Tom just asked. And, some of the situations, well, it's your judgment at the end of the day, but there's probably a logical explanation for what you're doing. We're basically asking a question so we can, asking the dumb question so we can do our role.
Well, let me ask the dumb question. If you're going to bench everything against the MSCI index in the ag, why don't you just buy the MSCI index in the ag? Why do you even mess around with this? I mean, I'm trying to get you with what the Wilshire, so there's a reason why Wilshire and Ibbotson doesn't do this for the large pensions. I mean, there's a reason. It's because when you look over time, right now, yes, large cap has been the strongest place for the last several years. It's not always that way. You can look back at there's different charts I can even send you on it, but why don't we just make it 65, 35 and get rid of all these classes then? If that's going to meet your goals, it's going to give you the cheapest, it's going to
Wait a second. Our goal is to get the appropriate, is for the township to get its optimal returns, and to, and you're responsible obviously for that, given the guidance that you're getting from the township, from the Board of Supervisors, et cetera, et cetera. We're basically just asking the dumb question, saying it's it's the age-old debate between actively traded funds and index funds, right? And there's different schools of thoughts on that. So we're just basically asking the dumb question about, well, geez, if one were doing this, it appears to us looking at this that maybe we're not, that the township might be better in indexes, for example. And then, if you believe differently, then we'd like to hear that.
You're in indexes. I guess what's confusing me, you're in indexes, you're just not on the MSCI as one big blob of an index.
Right.
If you take your equity portion out of this and look at that performance over time versus MSCI would be a good way to do it. I'm going to actually, when I get back to the office on Monday, I'm going to run this through your equity holdings, their indices versus the MSCI, and see how that breaks out, how it actually looks over time. Because we can do it through Principia and see that, because the MSCI is going to be predominantly large cap. It's just like if we look at the Vanguard Total Market Index, it's going to be predominantly large cap. All right. The MSCI would have US and foreign in it. but it's going to be a good way to bench what this looks like. Once again, and then the bond side of it, I don't think rates are going to stay like this forever. I think they're going to eventually have to raise them if we do have inflation. I want active managers under bonds, but if you say I want indexes, I talked to you guys about what my thing is with bonds. My clients have the actively traded bond managers, but we have seen, like right now, PIMCO Income is one of your best managers. He got hit during this March 23rd timeframe. I think he's going to come back with a vengeance. I mean, he's a great, Dan Ivickson's the best one out there in my book. I even talked about him in my book, for that matter. He's one of the best. He runs low duration. Your PIMCO hedge manager on the bond side does a hedging. The ag is not even in the foreign market. The ag is a U.S. bond market. So
I think Deborah, if I could I think what we're trying to do as a committee is there's a feeling that we need a simplified benchmark of 65-35 ACWI Barclays Ag.
okay.
And what I've been asserting essentially is that's not how we're invested currently. So what are your thoughts about us trying to fit a benchmark that isn't truly how we're currently invested? And therefore, I think as a committee, we need to, really come to a decision.
Yeah.
We want to be invested only in indexes at 65 ACWI, 35 Barclays Ag, and be the advisor, essentially. Or do we want to use our advisor and use the blended benchmark that she's providing based on how she's investing? I feel like we go around in circles.
On this, and you're right, Colleen.
Conversation.
We have not.
I feel like it just gets to be redundant, this conversation, frankly.
Well, the target weightings you have in there on page 22 is your weighting versus
Correct.
where you are. So that is giving you,
That's-
what that did is negative 4.93. If you take those 10% of the S&P 500, 10%
Right.
of the S&P, that gives that. What I don't give you here is the 65-35. But I have no problem in adding that. I have no problem in changing these target weightings versus what that index did in that period of time on that same page there on page 32. I can add that MSCI underneath this and say what that did on the same page, if that helps you.
I think it also would be helpful to understand, like to Tom's point, what is your conviction as our investment advisor on investing in growth and value as opposed to 100% blend, both domestically and I think internationally we have we have emerging markets and I think large cap international, IFA. So do you have conviction regarding that? And should we look at saving money and just, being blend straight down the category? I think we're looking for some conviction either way from you.
Yeah, I have
And not to put you on the spot right this second, but maybe, put some dialogue on it next time or provide us with something in the future. Because
No,
that's one that we keep going around on, I think.
It's because I have a major conviction for it. And I even wrote about this in the book that I wrote. It's because you will see periods of time when growth outperforms value. And there are major changes. If you look at over time, if we go back to 1999, growth outperformed value. And it looked like it outperformed for the 20 years. Then you go back to 2010 and values were outperforming growth for that 10-year period. During that time, if you have value separated from growth, let's look at 2000, the growth side of the market was falling apart, whether it was small cap, mid cap, large cap, because technology hit a bubble. Just like we're probably approaching a bubble for technology at one point in the near future, or maybe the future, maybe not the near future. Then you see the value side in 2000 did phenomenal. Value did great in 2000, 2001. It allows me as your manager to take some money off of growth, add it back to value. It allows me to do some rebalancing that helps out the portfolio performance numbers. If it's all sitting in one,
not to interrupt, but if we were strictly in 100% blend, correct?
you can't do that. You can't
do that with your
You can't
flow. Correct.
You can't do that whatsoever. And
Right.
if you're and not just that, if you look over time, in 2013, small cap growth was the best place to be. If we look at, it's hard for me to read this one thing right here with the light, but in 2016, small cap values of 31.74, for instance, whereas growth itself, the core was up 12. So the S&P was up 12.05, small cap values of 3174. That's huge. You can take some profits off small cap value, move it back into the growth. Then the next year when things change, it's kind of like what we saw back in 16, where international was at the bottom of the asset classes. It was only up 1.51. Small cap values at the top of being up 3174. But then the next year, we literally saw international moved up toward the top. So it allows you to do some rebalancing where it's all in one big MSCI. There's no really rebalancing because it's a passive index. So
Right.
we're allowed to, does that make sense? You can take a passive, take from this place over to there.
I guess I just want to point out from our perspective, that's sort of the think in the committee is to simplify the benchmark. But if you're simplifying the benchmark, you're benchmarking, you have a benchmark that's not exactly how you're currently invested. So do we want to invest the way we're benchmarking, or do we want to benchmark how we're invested? And that's where I feel like we keep going. So I just wanted to hear from you as our advisor on what is your advice on that? From a committee's perspective, how should we be looking at this to really be able to gauge performance? That's really, I think, where we keep going around.
First off, your benchmark for what you have is how you should benchmark. If I'm sitting there with all your money in large growth, that should be benchmarked against the Russell 1000 growth.
Right.
If all your money's sitting in the small cap value side, it should be benchmarked against the index that ranks against the small cap value. That's why that page 22 is very important. Now, what's interesting about it is if you go to this next page 23, that's actually what's happening if you had the indexes how I have you allocated, where I took, maybe I've got a little bit more in the large growth versus the value or whatever, but it takes that into play on page 23. Now you see what's happening with the actual mix that you have, because that breaks it down by actually what you have in large growth and what you actually have in small value. It's not based on the targets.
Can you provide an aggregate total equity and fixed income return for our investments?
Recurring, what do you mean by recurring? What do you mean by that?
Could you provide an aggregate equity return
Yep.
and an aggregate fixed income return for the portfolio in each period?
Yeah, it's on page.
Because we don't see that. We see individually as you lay out. Because that would help us determine the total contribution to performance. Is it coming from equity? Is it coming from fixed income?
Yep.
It's
Yeah,
very
I
hard
break
to
it
see
out by the actual asset classes, but I can do that
You
exactly.
can look at page 23 and you can add up the US stock and the non-US stock return. And that's your equity return. And then you add the bonds and the cash, and that's essentially your fixed income return.
It doesn't break, he's asking to broken down per the class. He wants the equities broken out, not as an aggregate together. It
No,
does.
he wants aggregate.
No, I want
He
that.
wants aggregate, right.
Oh.
We
Well,
want
23
equity versus fixed income.
Yeah, so the equity return will be weighted to our targeted weightings times the return we've earned gives us a cumulative number that will be our equity return effectively. Very tedious to do and figure out otherwise. So that page 22, if two columns were added to that, the benchmark return for the specified targeted weightings.
Okay, hold on, benchmark return, okay.
And the actual investment return for the targeted weightings. And then we could compare one to the other. Did small cap value underperform? Did it contribute to our equity performance, or did it not? And that would also help us.
But wait a second. You do see that on page 20. I mean, on page 20 and 21, it shows very clearly where you're on the year-to-date column, where your numbers are coming from. Maybe it'd be better for me to put next to that 10%, next to that the percentages of where you have things. Would that be easy?
If you could do it asset weighted on page 22, that's what Tom's asking for. On page 22, can you weight out how much of our total portfolio is in that asset class? What were the returns for the benchmark you're reporting against, and what were the returns that we actually received, which we understand in the equity portion, it's going to be very close, net of fees.
Yeah.
But more importantly, in fixed income, because we're using active managers, how do we isolate and see how
Okay.
our fixed income, our 35% of the total portfolio, how is it done?
I see that. So you want me to break out the asset of what you actually have, the asset weight of it, then the benchmark, the return of it, of each one of those separately. Okay.
On that page 22 as a summary, right?
FYI, that's not a new request. That was probably requested a year or so ago by myself.
But I put it
Enough
out.
said.
I know, but I sent these reports to you guys, and remember, because I broke it out by 2021, I did it in a way that I thought it was too much. There's so much data across these because you wanted running totals. So I left it open in that meeting. We had a call. We didn't have a Zoom call. We had a call, and it was like, no, the reports look okay. But I would have changed this. I'm not having trouble changing things. I just want to make sure I understand what you're looking for. I mean, I'm on your side. I'm on your side. I want to.
We know. I think my sense is just a little bit of a disconnect. So it's no big deal. So if you can get it, that'd be great.
Okay.
So the other issue question I have, we have 23 investments, 12 in equity,
Yeah.
11 in fixed income. So my question is, which were the top three contributors to our performance in a period, and which were the bottom three?
Well, I can look at that and
I
get that.
cannot tell that from the data.
On page 20, it clearly shows that. On page 20 and 21 gives you where it's coming in from. So you can see that on 20, large growth year to date was up 7.74 is what you saw. Okay.
It's not weighted again. We only have 10% in large growth.
Right.
And unfortunately, and we have investments in mid cap, small cap, and value, which are detracting, obviously, on the equity.
But I don't have a crystal ball. So my thing is, I can't say should we be in value tomorrow more over growth. I'm gonna go with what makes the most sense to keep you totally balanced. And I'm overweighting slightly on the growth side, but I've got to be careful in the sense that there's a fiduciary responsibility on this account. I can't take big bets on value over growth. I mean.
Oh, so we're overweight in growth because it's outperformed value, clearly.
And I could choose to cut it back, okay? I could choose to make it back to what it was. I chose not to. I let it keep riding to a level where it's still acceptable to ride it.
So I will say this kind of comes back to the very beginning. We are continuing, although slowly and with halting progress, to review the investment policy statement. And so there's a lot of things have fallen out of that, but it's we have not rewritten that. We do intend to do that by year end. So when I look at the IPS, there are only three things that are specified in there. 45% domestic equity, 20% international, 35% fixed income. That's our 65-35 right there.
Is that on the investment policy statement that I wrote for you recently and sent over? Or is that from your old one that was signed many years ago? Because I did put a lot of energy into sending you a new investment policy statement.
Well, the high level allocations were in the investment policy statement. The targeted weightings obviously come from you, which are fine, which are understood. I mean, that's your value add. And so when I say we come to this reference benchmarking thing again, it just helps us to give us a very high level view of what 65-35 looks like, because the MSCI equity is domestic and international, mostly large cap, granted. The Barclays aggregate is, again, it is a unique, is it a perfect fixed income benchmark? Probably not. But we're trying to distill all of this down, as Ed said, for simplicity. And so when I look at, so when I look at this reference benchmark over a trailing year, it's at 4.4%. Our portfolio is at 0.25%.
What about over 5 years? You looked at it for 1 year. What about 1 year does not make even anything. You can't even judge a manager on that. It's like there's got to be at least a market cycle you look at it over, not a 1 year basis.
Well, I'm not looking at it on a quarterly basis. Let's put it that way. And we don't have geometric returns anyway for the fund. So that's a whole other issue. And
would you guys like me to just quit? I mean, I'm really feeling like whatever I do, I can't get it right anymore. And I really want to do what's right for you guys. I mean, I put a lot of energy into this account, and there gets to a point where no matter what I do, I can't get even, I don't know, I'm just pretty frustrated right now. And I'm very sorry.
I don't think anybody is asking for you to quit by any means, Deborah. And I think everybody on this call, Ed, I'm sorry, I'm just going to speak up,
No. Everyone's entitled to speak up.
Yeah, I don't think there's any need for someone to think about quitting, but you understand that we're trying to do the best, like you are, as you are a fiduciary, and we're acting in a prudent capacity to do the best we can for this group. I do believe there's some conviction with some of the group that perhaps being straight index is the way to go. That's what I'm feeling. I can't say I agree with it, but I do think that's where a lot of the analysis is going. So, there may be a point where we have to talk through the IPS. What is our recommendation to the board? Ultimately, it's up to them.
Well, yeah, at least speaking from me is I wasn't necessarily getting that impression. At least my view is that certainly one choice the township has is investing in strictly indexes, right?
Uh-huh.
And so, and that would be, it's a simple and cheap way to go, et cetera, et cetera. But if the township can hire an investment manager who does better than the index, then that's obviously what the township wants to do. So I think as a sanity check, well, at least one of the sanity checks would be to say, all right, let's just see how the investment advisor is doing versus a strict index. And certainly and as Deb was saying, over periods of time, that's what we would hope we would see. I think it's just a sanity check. I don't think people are advocating anything. I think it's just a sanity check. Now, certainly if it plays out that way, then maybe we need to rethink it. But
Yeah, I don't think looking at one-year returns is.
For what?
I don't think looking at 1 year returns is.
Well, no, I don't think anybody's suggesting that. I don't think anybody's suggesting that.
Well, one of my problems is when we did this report and we went through compliance, we went back and forth on this report.
Right.
We went through page by page and I said, what do you want me to change? And this was like, fine. The last meeting when I physically came down there, you guys started talking about MSCI. You never came back to me and said, this is what I want done on this page, or it would have been done on this page because
we hadn't really together decided what we wanted to look at. And so what our plan was is after this meeting is we were going to come up with, if we saw any changes that we wanted to do, we would come back to you after this meeting. That was our intention because we were working on other things at the time. So I apologize if you got the different impression.
Yeah, and I would like to clarify just from my position. Deb, I worked with you and Joe on building out a new report, and I truly believe that the report you've provided to us is adequate and was what we requested. However, the committee is looking at benchmarking in a different way. So
I got it.
That's what we're asking for, and that's where it changed just very recently.
Okay. So in other words,
Deborah, I have to concur with Colleen. Colleen and I were the two that were within the subcommittee to work with you on the report. And the report basically was what we requested. But subsequent to that, we've had new members. We know more. And by no means are we looking to replace the messenger.
Okay, thank you.
What we're trying to do is understand. And the pension problem is not just a performance problem, it's also a funding problem. Okay, so we're trying to attack this multi-head problem, from two sides. One, can we improve the performance?
Mhm.
Two, do we understand the performance?
Right,
And three, what do we need to do to increase the input to get us closer to the actuarial present value of the liability, which, depending upon the interest or discount rate, is a multi-million-dollar issue,
right.
which
Right.
I hate to say this, but the Board of Supervisors has, in my opinion, done a kick the can down the road. Okay? They do not want to fully fund the pension plan in my estimation and the task force estimation is the proper amount to get it back to equity.
That's right. And so, and so, I mean, that's certainly the thing we're working aside. So again, we apologize if you're getting if you're receiving the wrong message. That wasn't certainly our intent. I think when we came up with this report, we came up with something, and then with the hope that, as we learn more, we would work with you and to refine it and
Adjust it. Yeah.
and adjust it. And with the end goal that, down the road is, we're all volunteers here. We're going to be here forever. So that something would stand the test of time. And also that the Board of Supervisors could understand, because they know a lot less about finances than we do.
Yeah, Tom
That's,
made
that's,
some
that's, strictly, that's strictly where we're coming from.
and Tom made some great points. My thing was, I was just receiving it like I should have had this on this report, but nobody did give me the actual change it.
Well, you're absolutely right. You're absolutely right. And so we're trying to. Our goal is to get to figure out what we need to get your reaction to some of the stuff, and then say, here, Deb, these are some of the changes that we'd like to see. That's what we're trying to do.
Can I ask you for one thing? So if because you're going to have your meeting after I get off, if you can just send me a quick email, because Colleen was saying what she wants here, but I'd like to see it in writing about what page and what you want changed on that.
Absolutely.
And then I will make it like that. And then I'm also going to do some numbers based on the MSCI, because Tom brought up a really good point. And it makes sense to me how when you're dealing with the Board of Supervisors or anybody, I mean, I deal with a lot of high-end people, physicians, CEOs, whatever. They want a bottom line number. They don't want to sit here and look at a 30-page report. They want a bottom line. Am I okay? Am I not okay? What do I need to do differently?
And, frankly, we have that on page 22. That's constantly been my point, is we have a blended benchmark return at the top summarized on page 22.
Yep.
Blended by our actual investments in our actual asset classes.
Right.
So it's there. But what Tom would like to see, and I think the group would like to see, is also add a column on by each asset class. What's the weighting? What's the return? And then kind of be able to roll it up into how does it compare to a 65-35
MSCI.
ag, right?
Yeah, I got it.
That's what I think will just bring it all together. We could actually put that page in front of the Board of Supervisors and say, this is how the portfolios have performed.
I got it.
Deborah,
Then adding to it.
one of the issues that we had early on in these conversations with Colleen and myself and you was that certain things you were quote unquote governmentally or regulatory yes or could not provide. If it's something that you cannot, then what we need is the data so that we can easily compile that data to present to the Board of Supervisors.
Yes, I will
So
know.
you can't put in your package that data we need to know that,
Yeah,
but we need to get get from you that data so we can put it together so we can present it
Yeah.
in a summary fashion. Because what we need for the Board of Supervisors is a, 6 to 10 page summary and not 100 pages. Because
Right.
Yeah.
one, they won't read it. Two, they won't understand it. Nor should they be expected to.
Right.
Yeah.
And so
So
the-
we're
the-
trying to make it a KISS approach.
Yeah, the one thing I wanted to add is, Deb, you raised a good point, and I think I've asked this question before, but I can't remember the answer if I have. Having a report that shows year to date, 1 year, 3 year, 5 year, 10-year returns. Now, I can't remember if you said that was not possible, or could you remind me?
I've got to do with the trailing data. So what we have to have on file is whatever I'm reporting to you has to have trailing backup data on it.
Okay.
So for instance, when I'm showing you indexes, there's a backup data. We have pages and pages of data we have to submit with these reports for FINRA. So our compliance department allowed us to do, I guess back to 2010 on this, on this data here. We can go back in time as long as we have to have it on file. We have to have the actual data. So it's like I can go back and do the MSCI index versus these.
Actually, so where I'm going. So for example, we said that the year-to-date performance for the uniform, let's use the uniform as an example, is 5.81, right?
Right.
So what does that look for example, just the performance, what does that look for the last 12-month rolling, 3-year, 5-year, 10-year? Is it possible to get that actual performance data?
I can't go back at this time and do it because the reports would have to be fabricated because it's I can only pull off the reports off the system as to what we have, and the reporting we have, we're using the top of the line like these the asset managers. They don't do these kind of reports. These reports are all put together by us. I mean,
if Deb, you would have to go back, you would have to go back and recreate
A
them.
dumb question. This isn't an industry standard to show it this way?
the way you're showing is not an industry standard.
No, I'm just talking about in aggregate, the aggregate portfolio return.
No, we can show that, but not in this kind of the format that you're seeing. It's like I pulled up for you this morning where I was pulling up what your different all the different asset classes did from 1/1/2002 to 8/9/2020 for me to get a comparative of how you've done with your index versus what the actual index did if you didn't have any money coming in or out of it. There's certain kind of reports we can pull up, and the standard reports, I don't use. What I'm trying to say to you is, like the report, if you go to page 11, look at page 11. That's a standard report. That one right there. That's a standard report that we pull right off of our systems. The other ones are pulled in data. Page 4 is pull in data. Those are just S&P numbers that are coming in, and they're coming out of Morningstar. When we go into the reports that we have are like page 10, that's actually right off the computer. That's right off your, we can go back in time and do those till the cows come home. What I can't do is like page 13 is created. That's a created, most of these pages are created. Page 14 is the actual right off our computer systems. And our systems do all kind of numbers for us. It'll give us performance by security from when you start in that security. It'll give us when money comes in and out. It gives us a ton of data that we can do. But it's not put together in these formats. The page 20 is created. Now that's data.
So let me just let's just go to, for example, let's go to which one is it? It's slide.
It's part of the issue, the fact that it's part of the issue, the fact that we went.
Joe, hold on, Joe.
I'm sorry.
Hold on. Page 15.
Page 15. Okay.
All right. So the one number, the only number, so you have on there, the last number is minus 5.92. That's the performance
Right.
For year to date.
Right.
So that one number is not possible to get for the last 12 months, that one number. So June 19 to June 20.
Yeah, we can do that. You can get that one number from June to June, absolutely.
Well, that's what I'm talking, that's what I'm talking about. So can we get that number for the last 3 years?
We should be able to get that last number for the last 3 years. That should be no problem on that.
All right, and then the last 5 years.
So,
That's
1
what I'm
year.
talking, that's what I'm talking about, that one number.
oh, I see what you mean. Okay.
So
Yeah,
that's
1 year.
basically, it's a portfolio return. I mean, to your point is that you have to evaluate the investment advisor over multiple periods of time, right?
Yep.
So, you know, we're only looking at one number. If we were to have because I can get it, I have a Vanguard account. I can see what my year-to-date return was, 1 year, 3 year, 5 year, and
Yep.
Yeah.
So do you
I'll
want,
point out, Ed, just the reason you can see
If I
that-
can interrupt,
I'm sorry, let me just.
if
make
I can
my-
interrupt,
No,
we have been in passive index funds since like 2018, and Ken Wallace can correct me. So
Right.
looking back
2017
over 5 or 10 years on performance is a
isn't it
moot
help?
point since we
That's
were
right.
never in those funds.
That's right. You got into the funds on 3/7/17. You've been in it since 3/7/17. So you're right. It would be a moot point to go past that. But
So looking at history has
so
nothing to do with our performance.
why would it be a moot point?
because it's going to go back on investments, well, you can, but we're
Because
now,
it doesn't reflect what we did because we were in active managed funds prior to 17. Ken, and I remember that there was a Ways and Means Committee mention of moving it to index funds, and that was done in the last 3 or 4 years.
right, and we
So-
had,
Well, I'm just looking for one, the reason I'm looking for the one number is so we can show, so we see how the portfolio is doing. And we explain it to the board of supervisors to say, hey, look, we're talking about the 8% return. In fact, we're not getting an 8% return. If we have those numbers for the actual portfolio over those time horizons, that basically bolsters that argument. That's all it is. Obviously
And I hear you, but we can't look back 5 or 10 years ago and say, had we been there, because that's not what the marching orders were that were given to Deborah. So if we're trying to compare Deborah's performance to what a historical performance could be, and again, I'm not trying to defend Deborah, but it's not something that.
Well, I tell you what, let's not waste Deborah's time on this.
Okay.
What we need to do collectively is we need to, and to make it fair on Deborah, we need to show her specifically what we're looking for. So we need
yeah,
to.
and then I'll go back to compliance and as to what I can give and whatever. But the reports we have are, they give us so many numbers all different ways.
Right. So Deb,
And we
Deb,
can-
no, wait, we don't need to waste any more time on this. Is
Can-
we need to
email
come,
them?
as a group, we need to come up with whatever enhancements we want, and then you can tell us whether it's possible or not possible.
And Colleen, you had one thing you were trying to say, but you weren't able to say it. Colleen?
I really just wanted to speak to Ed's experience as an individual investor with like a Vanguard, where if your money is there and they are record keeping all of your accounts, you're getting aggregate returns.
Right.
If you're working with an advisor who's pulling data and assets from different accounts, even within their broker dealer, even within their custodian, it can be very difficult
Right.
to aggregate that into rolling return reports.
Colleen, I worked in finance for 30 years. I know that there's data, management will come up with data requests. And so that's what I said before, is we can mock up what we want. If she can't provide it because of data limitations, then she can't provide it. It's as simple as that.
Well, I was just pointing out why your experience as an individual investor.
Oh,
with
no,
Vanguard-
Colleen, I know. I work in finance. I get it. I get it.
Okay.
Believe me, I get it.
But we do have certain restrictions and they have just knocked, FINRA has been, because there have been advisors that have made up these reports and they put in their own data and they've used Excel spreadsheets. We can't even use an
So
Excel
we don't want
spreadsheet.
to do that. We don't want to do any of that.
Yeah, but that's how it'd be
Well,
figured out.
I'm just interested in the art of the possible. If you
Yeah.
can't do it and it's not compulsory, then we won't do it.
Okay, that sounds good. I think I understand things better, and I'm sorry I had a bad reaction. I was just thinking that I should have been doing something that I really wasn't told clearly to do.
No,
And I know we talked about it.
haven't. We haven't. So you know, we probably should have said, you know, well, everyone on the committee knew it, but you were the only one who didn't know that we after this
Actually-
committee, we were going to get back to you with the feedback.
Yeah, but Tom had brought it up, and I remember distinctively, and Nate and I even driving back, I was saying to him, well, we gotta add that, you know, if that's what they want to do and change things around. And then, you know, I just thought you guys decided against it because it was an aggregate. But anyways, all right, you're gonna send me an email and then I'll go from
Yep.
there.
Yeah, and so maybe also we may just to make things simple, we may try to one or two or three of us can give you a call offline, and we can very efficiently just sort of figure out what's possible and what's not possible.
Yeah, well, I will know. It's better for me to get it right because I have to do it. I gotta get it through compliance. I don't
That's
really,
fine. That's fine.
but sometimes I'm shocked at what, like when I wrote my book, I can't tell you how much of that, we spent so much time in compliance because you think you could put something on and they won't allow it.
Right.
And I also get restricted a lot because of all my registrations. I have all registrations. If I was just a registered investment advisor, it's one thing, but I've got all these other heavy registrations. So I've got even a higher compliance on myself because of that. So,
Right.
So,
No,
Great, guys.
you know, there's rules. We get it.
okay. Well, thank you guys. And thank you for all your feedback and help.
Yeah,
So-
well, thank you for your patience. You know, we
Yeah.
it's we're all volunteers here, so it's not like we're getting paid for this.
You guys do a lot of work for volunteers. It's good.
All right, I appreciate that. So anyway,
Appreciate
we got one thing we're going to cover in addition to this, so we appreciate you calling in.
Okay, thanks, guys. I'm gonna
Thank
get off.
Thank you,
the call.
Deborah. Thank you, Deborah.
Okay,
Thank you.
bye, guys.
All right, so the one other thing on the agenda was I'm going to share my screen. I don't know if you guys saw the email sent out earlier today.
Yes.
Let me find it. Here it is. All right, can anybody see us?
Yes.
Got it.
Got it.
All right, so did everybody get the email that I sent out?
Yes.
Yeah, I didn't have a chance to
Yep.
look at it yet.
Okay. All right, so I got to figure out how to advance this thing. Advance it. There it goes. All right. So over the next couple of months, obviously the tax will be finalizing the budget, and obviously within that will be the pension, whatever contributions are going to be for the pension next year, and then obviously in the 5 years beyond that. So one of the questions that's come up is it seems to be a disconnect about the or people not understanding the point we've made about that there's a that the unfunded liability is a form of debt. So I took a run at trying to explain in simple terms that the pension deficit is in fact debt, and it's a 6% debt, 6% interest cost. So this is slide one, and again, and this is a draft, and so your feedback is welcome. So this is the summary from our presentation on May 19th. I highlighted in red the interest costs associated with the pension deficit is approximately $500,000 based upon the current deficit. All right. Here is a slide, the next slide, slide 3 here is a report that I found from the Hoover Institute, and which basically, you know, it reinforces the fact that unfunded pension liabilities are a form of debt. And I'll just read what is said in the report. And I have more on it and backup. Anyway, what is going on, in fact, is governments are borrowing from workers and promising to repay the debt when they retire. Accounting standards allow the bulk of this debt to go unreported due to the assumption of high rates of return. An issue that we're all familiar with, but here's the Hoover Institute making the point. All right, so here's my,
Ed, to that point, I think what is reported on the financials is the current debt based on the current discount rate.
that's exactly right. But their
The
point-
The
their
difference
point is that-
between the
point is that it's-
7.75 and our targeted 6% is not reported.
That's right, and that's exactly the point in the second sentence. Right?
Correct. And I'm not sure if you should elucidate on that issue on this slide
Why is
or
it-
somewhere.
I'm sorry, say again?
I'm not sure if that should be explained on this slide or somewhere in the presentation. The fact that it is being reported, but the unreported amount is the inflated discount
you.
rate amount.
I got you. Okay, yeah, that's a good point. Let me write that down. Okay. Okay, good, thanks. All right, so the next one is, believe it or not, there are nights where I wake up in the middle of the night thinking about these pension plans and try to come up with an easy way of explaining it. So this is my attempt at explaining it. So basically, I took a very simplified hypothetical example. So in this hypothetical example, employee X, age 55, earns a one-time pension payment of $10,000 when she turns 65. Obviously, that's not what happens in real life in 2030, but it makes the math easy. How much does it cost the township with this one-time payment in 2020, 2025, 29, and 30? So basically, it's the scenario 1. It's out 10 years. This is the present value calculation. So the present value is $5,584. If it was paid out 5 years ahead of time, it would be $74.73. 1 year ahead of time, it'd be $94.34. And obviously, in 2030, 10 years from now, it costs me $10,000. So one of the key points here is that, you know, one can see that over time, it gets increasingly expensive to make that payment. So why is scenario A the least expensive? In scenario A, the employee's pension benefit is earned and paid for in 2020. The funds are then invested for 10 years and benefit from compound interest rate returns of 6% per year. So obviously, that's the cheapest way to go, is to pay it as it's earned. All right, so then another question is coming. Yeah, then we obviously were in a situation where we got trade-offs about budget trade-offs. So here's an example, again, a very simple example of, all right, so during 2020, the township can't afford to pay its pension obligation of 5584 and its capital projects of 5584. Now that's the same number as in the previous, to keep things numbered, is a previous page. That's a 5584. I kept it simple, it's the same to keep it simple. All right, so a low interest cost loan, the township's cost of debt is 2% a year. And so if it's paid out over 10 years, the total cost of the loan would be 6166. So I have scenario 1 where the pension plan is paid 5584, and then the township would take out a loan, for example. And I'm not advocating the township take a loan, but I'm trying to say that it's a cheaper alternative. So the total payments for the township over 10 years is $11,750. Now in scenario 2 is the township delays the pension payments to 2025, but it pays the whole capital amount in 2020. you add those two together, it's 13,070,057, which is 11% more expensive. If it's delayed until 2029, the total payments would be 15,000, which is 28% more expensive. And if you wait until 2030, it would be 15,584, which would be 33% more expensive. So this is just, and I'm trying to add perspective to say that delaying funding the pension plan costs money, and it's not cheap money. Any thoughts on this?
I
Colleen?
like this illustration, and I think it's
Okay.
really helpful, especially because we've been talking about that 3 million that we're borrowing.
Right,
We're talking about, wanting to pay it back as quickly as possible.
right.
But, maybe this is a different way to look at it. Sorry, my dog's, my dog's saying hi. So maybe this is a better way to look at it where, instead of rushing to pay back that loan, that we fund the pension a little bit earlier.
Right. And the fact that delaying it is expensive. I mean, the township would be better off taking on more debt if it, again, if it's critical capital projects, then delaying paying the pension.
As I discussed with Ed, simply the cost of the pension fund over time is our highest cost of capital, period.
Right.
So the more we can mitigate that and ameliorate it, the better off the township is. As
Right.
difficult of a short-term decision, it's the best long-term decision.
That's right.
Well, yeah, I don't think, I think most of the supervisors understand that to some extent, that it's an expensive bill that we're paying because we're just basically, what Joe said, kicking the can down the road. But how do we solve that when we have all these other capital projects that we have to deal with and all these other expenditures? And this one is the less, I guess, visibly painful than some of the other items. So if we can just say,
But it's the most painful, in my opinion.
it is the most painful, but it's not visible. It's
Right,
not on the books.
and that's the unfortunate thing is so. Jen, to your point, that's what the next slide is. Is that this is something we've shown before, and even in our initial report, we showed this 3 years ago, saying that the township basically has three options. And we got this from, this isn't our suggestion. We actually got these from pension studies, which and the list of those are in Appendix A. So anyway, so township can either reduce pension costs, reduce township expenses, or increase taxes and fees, or some combination of the three. And the first one would obviously require that the Board of Supervisors, that's a contract negotiation. And basically all of these options are outside the scope of the pension committee. It's not our responsibility. We're just pointing out, again, what
Yeah,
What-
but they're only subject to
what these studies-
negotiation on
Sorry,
the
what?
police side.
again,
They're only subject to negotiation on the police side.
that's true. But then my understanding is that the non-uniform generally follow the results of the police negotiation.
But that's not
But
by
either
contract.
way,
It's by
Yeah.
the
Joe,
township norm.
I get it, but this is, Jen, raised the question is that, what do you do? Well, this is what these studies are saying. These are the options.
And then this PowerPoint is in anticipation of meeting with the Ways and Means at the end of this month.
Correct.
So we're going to talk about a lot of those details then.
Right.
That's my understanding.
All right. So then this is actually something that I was hoping Ken Wallace and Stephanie would be able to speak to. This is a back of the envelope calculation I did, that if the MMO if the discount rate were lowered to, I just took 2 points, 6.75 and 6%, that would result in an approximate increase in the MMO of 600,000 or 1 million. So I basically said, all right, well, if the MMO went up that amount, and there's approximately 6,000 households in Doylestown Township, plus minus, I don't know how many are. Ken, do you know?
That's about right. There's about 6,000 households.
Okay,
The average assessed value on a household here in the township is about $42,000. So
Right.
you're looking at $42 per thousand.
okay. All right, well, so it would be, my understanding is it would be the average per household approximately would be between $100 and $200.
Yeah, Ed, and, my comment there was, you're not really taking into consideration the commercial business properties.
You're absolutely right.
And so I think the township could tell us what percentage of our real estate tax comes from non-residential.
Right.
So you could modify that number.
Well,
So $100 may be $75.
right. So, I mean, if Ken could help us with that, that would be great. You know, to add in here.
Okay.
Then finally is, in closing, is that the advantage of funding the pension deficit aggressively is, one is it would save the township millions of dollars. We're talking about a lot of money over 10 years. We delay this, we keep delaying this, it costs millions of dollars. Right now, over the next 12 months, it costs $500,000. It helps to maintain the township's favorable bond ratings and keeps the bond costs low. It eventually leads to, eventually, once we get the deficit down, the MMO will go down. Because right now, it's like having credit card debt, is that you have a lot of unpaid balances. You get that unpaid balance down, your credit card payment goes down. So you lower the deficit. Eventually the MMO payment will actually go down. And then finally, it sends a positive message to both the employees and residents, because the employees who are addressing their pensions and residents, we're addressing the problem. So anyway, any thoughts on this?
The only other thing I think, Ed, that Ed Ebenbach has indicated that he's going to include our recommendation in the first draft of the budget that's presented to the supervisors.
That's correct.
So,
Okay, well, anyway.
And Ed, I think if you look back at Breedy's presentation,
Right.
and I can't recall the page number, but it's one that Colleen and I had asked for, which was input output into the pension plan. And right now, the contributions, if you exclude the additional payment, whatever it is, okay,
Right.
is about 90, right now, is about 90% of what is input on a monthly basis.
Right.
So, and it's not that much different between the police and the non-uniform. One I think was like 88%. The other one was 92%.
Right.
And I can't recall. I believe the non-uniform was the higher of the two. But on average, it was 90%. And it's only going to get higher. So it'll get to a point where the MMO will increase because you've got actual payouts.
Right.
And obviously you can't go below that number.
Right. Yes, that's right. So, we'll see how this plays out, but I think we got to keep pushing reminding the issue, and then whatever decisions are made on the budget, then we'll see what happens after that. All right. So just in terms of our report, I think, unfortunately, I think we were sending Deb mixed signals about what we're looking for. So we did our bit. We probably should have explained up front that we were going to get back to her after this meeting today about changes to the report. So what I'm going to do is, over the next month, I'm going to reach out to everyone and see if I can mock up what everyone's talking about, and then we can we can then react to a straw man next month and say, all right, this is, you know, this page we want changed and this page we want added, and we have it specifically laid out, and then we send it to her. Any thoughts?
Question I have is what do we report to the Board of Supervisors?
Well, we got to do, that's one thing
Because
that's on our to-do list,
right-
right? That's
Right,
what-
right now,
Right.
Deborah has reported to us. There's
That's right.
not been anything reported to the Board of Supervisors.
That's exactly right. So what we talked about coming up with a executive summary, so maybe we can start working on that as well.
I
So,
volunteer.
all right, so over the next next couple of months, so between now and the end of the year, basically, we're gonna be writing her on the pension contributions. We're gonna be hopefully wrapping up the investment policy, and then coming up with a draft of what the handful of enhancements we want Deb to make for the report, which would include executive summaries for the Board of Supervisors. Is that everything?
So Ed, if you need to bounce that off of me offline, like to see if people who don't know anything about this type of topic would understand what you're presenting, I'd
Right.
be happy to admit if I don't understand anything and like
Perfect.
so please send it my way.
Absolutely. Well, thank you. And I'll tell you, I can even print it off my printer and walk it across the street and put it in your mailbox. All right. So anyway, thanks everyone for participating today. Unfortunately, it was a little more. I don't think it worked out. You know, I think we were sending Deb not the message we intended. So
I agree.
Hopefully, we can do a better job next
I
time.
agree.
Okay. All right. Thanks again.
All
All
right.
right.
Oh, so we need a motion to adjourn. Joe, get a motion to adjourn?
Motion to adjourn?
Second.
All right, second. All right, good. We're done.
All right. Good
Thanks a
night.
lot.
Ciao.
Thank you.